Today's the second time, and we're going to concentrate on investment fundamentals. And the third time, we're going to hear tips from King Solomon himself, not today. And in the following week, you'll also hear, this may surprise you, why I don't invest. And it sounds funny, but I'll explain what I mean next week. Okay, why can't I do this? Caveats again. I'm not giving financial advice to anyone specifically. I'm not licensed. I grew up as an engineer, by the way, even though I had a summer job on Wall Street. I didn't do investments on Wall Street. I was a runner, which meant I was a delivery boy. I delivered stocks, bonds, and money. This contains general guidance, may be colored from my lens in situations, but I'm trying to give a general guidance. There's no cookie cutter answer. Everyone is unique. Past performance is not a guarantee of future performance. Conditions change. Be careful of old studies. The quiz again. And we're going to answer most of these questions today. Should you hire a financial planner advisor? Last week, we discussed it may be a slight advantage to do your own planning, but you could really make big mistakes. So most of the time, it's better to have an advisor. How much insurance do you need? We covered that last week. Same thing with what is a safe withdrawal rate. We'll start to answer some of the following questions today. Should you buy stocks or stock funds, bonds, a total bond index fund, or high yield bonds? If the market goes down 30%, what do you do? Do you buy low and sell high, which sounds like a really good thing to do? What did Einstein consider the most powerful force in the universe? It was not nuclear energy. It was compound interest. What are the three most important things to investing? Look at the Torah and Talmud for clues. We'll discuss most of those next week, but today we'll see what a Talmudic portfolio is. Investing. The three keys to investing. Unlike real estate, it's not location, location, location. It's allocation, diversification, and location. Some truths. If it sounds too good to be true, it probably is. You don't get something for nothing. Don't believe everything you read. Better is the enemy of good enough. KISS, which I always used in engineering. Keep it simple, stupid. Garbage in, garbage out. Conditions change. Old studies, analysis may not apply. Mitigate risks. You can't eliminate risks entirely, but mitigate them. Take a systems view. That means when you make decisions, don't look at the specific decision, but look at how it impacts other things. Never buy a financial product you don't understand. Generally, the more complex a financial product is, the more profit is built in for somebody else, not for you. Types of investments. Most of them are stocks, bonds, cash, real estate, precious metals. They may be other things like antiques, art, and collectibles. Personally, I've always invested just in stocks, bonds, and cash. My real estate investment is my house. Precious metals that I've invested in is my wife's jewelry. That's it. Investment risks. Before you invest in... Yes.
I have a question. This is Romana.
Sure.
What about, I mean, this is relatively new, but what about startups? I mean, investing in a startup is something which, you know, wasn't really open for most people 30 years ago, but is now.
Yes. So I would say investing in a startup is more akin to gambling than investing, because you don't know what you're buying into, and you don't know much. Generally, you won't know much about the company. So if you don't know a whole lot about the company, why invest money in it? If it sounds good, you might want to invest, but there's probably a lot of smart investors who've looked over the books of the companies, read all their financial statements, and have a better handle than you and I on investing in them. Hope that answers the question.
Yeah, okay, thank you.
Okay, investment risks. There's many, many investment risks. There's a market risk. The entire market could be down. Concentration risk. You've invested in too few assets or sectors. That's why I don't like to invest in individual stocks. I like to buy the market. Default risks, like bankruptcies or restructuring. A lot of new companies, just like restaurants, could go bankrupt. Inflation risk. You could be earning less than inflation. So if you buy CDs now, you're probably investing in something that's returning less interest than inflation. If your money is in a checking account or a money market fund, you're probably getting next to nothing and losing money against inflation again. Interest rate risk. If you invest in bonds, particularly long-term bonds, and the bond rates go up, the value of the bonds that you've invested in go down. There's a mortality risk, especially for annuities. If you buy an annuity and die a year or two later, you get you get nothing back unless you bought something with a guaranteed 5 or 10 years of return and you paid for that as well. Horizon risk. If you don't have an emergency fund, if there is an emergency, you have to take money out of what you invested in, and that could come with penalties as well. A longevity risk, that means you've outlived your investments. Foreign investment risk. There's exchange rates, there's laws in other countries, and there's dangers where you don't have if you invest in US stocks. Personally, I don't invest any money in foreign companies as well. One of the reasons is at one time, the foreign markets didn't move the same way as US markets, but now many, many companies are multinational. So what's good in the US is good overseas as well. A tax risk. There's changes in the tax code all the time. A sequence return risk. Markets could go down at the wrong time. Successful investing is managing risk, not avoiding it. And that's a quote from Benjamin Graham. Benjamin Graham was Jewish born as Benjamin Grossbaum. And he's the father of value investing. He's Warren Buffett's mentor. So what he says carries a lot of weight. Historical returns of different investments. If you invested in $1,000 in 1988 and looked 30 years later and adjusted for inflation, you could see that the US stock market almost went to $10,000. Large caps about the same. Small caps were better than large caps. And stocks usually do better than bonds over the long term. So short-term treasuries, not so good. Long-term treasuries better than short-term. Long-term corporate bonds, a little bit better than long-term treasuries. High-yield corporate bonds, and the word high yield could be misleading because it doesn't do as well as long-term bonds. High-yield bonds are often called junk bonds. They pay high interest, but they're paying high interest because usually the companies are in default or close to default. So it's not a good thing to invest in. Real estate does pretty well. Gold, that has done the poorest of all. And if you've heard a lot of TV ads or radio ads telling you to invest in gold, just be careful. And that's why I said, don't believe everything you read. Gold has not been a good investment. When you invest in things, you don't necessarily invest in something that's going to pay the most. And the reason why is there's a return versus volatility. Volatility you could think of as risk. So things go up and down every day, every month, every year. So you could see the average return of stocks are doing well compared to bonds. Bonds have very little volatility, but they don't pay very well. And usually small cap stocks have greater volatility, and that's measured by standard deviation. I won't go into the math to tell you what standard deviation is, but it's a measure of volatility. And I think there's an error on here because I think small cap stocks over the long haul usually pay more than the S&P 500, which has both large caps and some small caps in it. But small caps usually have a higher return, but at the price of higher volatility. From Warren Buffett, if you are not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And that's important because stocks have large standard deviations. So if you invest in a stock and take it out 2 years from now, you could very well lose money. And I'll have some more view graphs that show that. And of course, past performance does not guarantee future results. If you look at the stock market, like the S&P 500, which is often called the market, you could see it's gone steadily up, but sometimes it's gone down. So sometimes it has sharp declines, but over the long haul, it's generally going up. So be careful on the downturns. Eventually something will go down, but it'll go back up. Invest with your brain, not with your heart. So be careful of what you invest in. If you live in this area, for example, and see Pfizer, a lot of people invest in Pfizer stock. That's almost called investing with your heart, because you're investing in it because it's a local company, not necessarily because it's doing well. Invest with your stomach as well, because if the stock market has a sharp decline, you might be tempted to sell. And that's absolutely the wrong thing to do. Some advice. Bernard Baruch, who was, again, Jewish, a famous investor. I went to City College. One of the financial school is named after Bernard Baruch. So he's a famous investor. I think he gave advice to 6 different presidents. Don't try to buy at the bottom and sell at the top. This can't be done except by liars. You never know when the tops and bottoms are. Same thing with John Bogle. The idea that the bell rings to signal when investors should get in or out of the market is simply not credible. So it's generally always better to be in. If you look at the 1929, you could see there was a big stock market crash. And it took many, many years in this case for the stock market to catch up to where it was, about 1955. Warren Buffett has 2 rules of investing. Rule 1, never lose money selling. Rule 2, never forget rule 1. So when things go down, if you could afford it and don't need the money, that's not the time to sell. The market will eventually go up again. Bond yields. If you look at 10-year treasuries, they've gone up, but they're way down. So even 10-year treasuries, I think, are paying right now about 1.5%, which is slightly higher than inflation. So with interest rates so low, many people are looking at alternatives to bonds, and I'll discuss those in a few minutes. Changes in the price of bonds are inverse to the yield. So as bond prices go up, the bonds that you currently have go down in value, and vice versa. So with yields so low, and they're eventually going to go up, the bonds that you hold are going to go down in value. Another reason why people are looking at alternative investments. This is what typical treasury yield curves look like. If you look at this, this is years on the x-axis, interest rates on the y-axis. So the longer term bond that you buy, generally the more interest it pays. It's paying more interest because you're taking more risk. Things could go even higher in value. And this is what a normal curve looks like. Flat yield curves means that generally short-term interest rates are equaling long-term interest rates. And something that's rare is short-term interest rates are higher than long-term interest rates. But the normal yield curve looks something like that. And that's true for CDs. If you buy a 5-year CD, generally it's going to pay more than a 1-year CD. Some asset class returns. This is another view graph. There's lots of them, and it changes over different periods. But if you look at inflation rate and gold, they're just about keeping pace over the years. If you buy gold, essentially you're buying something that's increasing or decreasing with inflation. Bonds are doing better. Stocks are doing way better than that. Real estate over this period has done at least as well as stocks. So real estate has done pretty good as well. Buying gold. There's different ways to buy gold. The most direct way is to buy physical bullion in the form of bars or coins. I don't recommend buying gold, but if you do, this could be expensive. There's dealer commissions, there's sales tax, storage cost, and security. Physical gold is probably less liquid and more difficult or costly to sell. On the other hand, if you really wanted gold, there's exchange traded funds that track gold and could be more liquid and cost effective. And you could buy it with expense ratios as little as probably 0.17%. But again, I don't recommend buying gold. Since bonds are paying out so low, people are looking at different investments. There's firstly high yield bonds, which I call junk bonds. Sounds good because they pay more interest than regular bonds, but lots of those companies go bankrupt and you don't get as much as a regular bond. Bitcoins. A lot of people are buying Bitcoins now, and you could make fortunes or lose fortunes. There's drastic ups and downs in Bitcoins. So people think of Bitcoins as Ponzi schemes. And I'm not sure what the value of a Bitcoin is, because it doesn't seem to me to have any intrinsic value at all. There's nothing backing it up. Real estate investment trusts, and there's several kinds. There's ones that invest in commercial buildings. There's some that invest in cell towers. There's some that invest in malls. There's some that invest in a combination of those. I don't know if this is a good time to buy into real estate. If you go to the Crystal Mall, for example, it's almost about half empty. I think Macy's is closing in 5 days or so. JCPenney's is not doing very well. I think the same is true if you look at downtown storefronts. There's lots of empty ones. On the other hand, the market is self-correcting. So if you buy into a real estate investment trust, the value or dollars that you pay probably reflects what the expected return is and what the value of the overall assets are. But I'd be careful. I personally prefer stocks and bonds to real estate investments. Asset allocation. That's the most important contributor to long-term investment returns. And usually we're talking about stocks, bonds, real estate, and cash. And there's something called even a Talmudic portfolio. If you look in the Talmud, you'll find investment advice says basically 1/3 in business, 1/3 in real estate, and about 1/3 in treasuries. Personally, I don't like real estate. I prefer equities and treasuries or commercial bonds. And why is asset allocation important? Because if you buy stocks and bonds, bonds may go up when stocks go down and vice versa. So you'd like to buy different asset classes because they do different things. So over the long haul, even though there's a lot of volatility, especially in stocks with each one, over time, you kind of get to an average value, and that's called reversion to the mean. So it's good to hold on assets for a long time. It says don't buy only stocks or only bonds, or certainly don't put all your money in cash because it returns very little. How do you determine whether you buy stocks or bonds? And here's some different ratios from 100% stocks and 0% bonds, all the way to the opposite of 0% stocks to 100% bonds. And you could see over the long term, the more stocks you hold, the more return you're going to get. So 100% stocks might return a little over 10%, where 100% bonds will return 5%. But you'll pay a price for owning only stocks. For example, over, I think, the period from 1926 onwards, if you look at just stocks, there's been 1 year where it's gone down 43%. I don't know if I could stomach that. So if you had $100,000, for example, and you lost $43,000 in 1 year, to me, that would be devastating. If you invested in bonds, you only might lose 8% in a year. Most people will invest in what's called a balanced portfolio. That's usually anywhere between 60% stocks, 40% bonds, to 40% stocks, 60% bonds, sometimes 70-30 to 30-70. And you could see, for example, if you had 60-40, it's returned 8.7% and only gone down about 26-27% in 1 year. And if we look at that, here's another slide for a different period from 1926 to 2013. So it includes the stock market crash. The average return on a portfolio consisting of 60% stocks, 40% bonds, returned 8.9%. The best year was 1933. After the big stock market crash, it gained almost 37%. The worst year was not 1929, it was really 1931. It went down about 27%. If you had a 60-40% portfolio, out of those 88 years, it had a loss 21 times, which means a quarter of the years you've lost money. So there's certainly no guarantee, even with a 60-40% portfolio. The 60-40% portfolio is the old standby, and it's often quoted as the rule of thumb for the portfolio to use, As a matter of fact, Bethel usually invests its money with a 60-40% portfolio. And that's what financial advisors usually recommend. Here's another view of looking at time horizon. And what we see here is in the deep purple, we see stocks, slightly lower coloring for stock bond mix, medium purple, bonds, a light purple, and short-term investments, almost no purple at all. And you could see if you invested for 1 year, if you invested in stocks only, it could have a large range of either going up or down. So if you invested in stocks for 1 year, it's almost like gambling. There's almost as good a chance it could go down as going up. And that, if you look at this chart, I'll go through some of it. The stock bond mix, slightly better than just stocks. Bonds for 1 year, even better than that. Short-term investments, you won't almost ever lose money, but you're not making money either. As you go off in time, 5 years, 10 years, 20 years, 30 years, 40 years, what you'll see is at 5 years, you're better off, and this is close, a stock bond mix or just bonds. At 10 years, probably the stock bond mix. At 20 years, probably a little bit better is stocks or stock bonds, or a higher ratio of stocks to bonds. As you get out to 30 years, almost all stocks. And it's certainly 40 years, the only thing you would want to invest in is stocks. So depending upon what your time horizon is, that tells you what you want to invest in. And that's why last week I said financial planning is important, because you have to look at what your expenses are when, and that tells you for that particular expense what to invest in. So if you're investing in something, if you're going to buy a car in 3 years, you don't want to put your money in stocks. You probably want to have most of your money in bonds and cash. If you're investing, if you're young, real young, like 20, you might want to have most of your money, like 90%, in stocks. And as you get older and older, have more money in bonds than stocks. Any questions on this? This next view graph is hard, so it'll take me a while to explain. In 1990, there were 3 Nobel Prizes awarded. 2 of them were awarded to Jews, Harry Markowitz and Merton Miller. The third was given to Sharp, and I'll talk a little bit about this. Harry Markowitz is called the father of modern portfolio theory, and he devised a way for the optimum place for asset allocation. So almost every big company who makes investments uses this. And I'll go through this. If you look at these yellow circles, This represents individual assets that you could invest in. Some of them have higher expected returns, like this or that. And usually with higher expected returns, there's also higher volatility. So if you look at this axis, you'll see this has a high volatility. That has fairly high volatility. So what the theory says is there's a mix of assets that you could invest in. So you shouldn't invest in 100% each. So depending upon how much risk you want to take, you could be anywhere on this curve that tells you here's a trade-off between return and risk for the portfolio that you want to carry. And it's called the efficient frontier because you can't get numbers that are higher than this. So you don't want to get numbers that are lower than this either. The best place to invest is called someplace on this efficient return frontier. And how you find the right place, you could look at a risk-free rate, like a 3-month treasury bill that has no risk at all. And if you draw a tangent line from that point to this efficient frontier, this tells you, here's the place that I want to have my portfolio. So if you use the right software, it will tell you how much to invest in each of these assets. The Sharpe ratio is called the expected return minus the risk-free rate over the standard deviation. I was personally impressed when I met with our Bethel financial advisors because he used the term Sharpe ratio, which I knew of, but I've seen very few financial advisors use that term. So that's a good place to be. And somebody who's giving you financial advice should understand that. When I personally looked at my own assets in my retirement account, I looked over time frame. And what happens is your asset mix should change over time. If I had looked at a long time frame, like over 40 years, that would say I want most of my money in stocks. If I was starting to look at shorter time frames, like 30 years, I want about 70% of my money in stocks. If I needed money in 10 years, this told me I needed to have about 20% of my money in stocks, and so forth and so on. And you could rebalance your funds or mix of assets over time. And there's a little view graph that's over here. And if I went back to this curve and showed you what this looks like, if you look at over time, that curve changes. So the longer your time frame has, the more this curve started to move this way. And if you drew the line from the risk-free axis to be tangent, here it would intersect different places on this curve. And that's how this is built. Of course, one of my favorites, Yogi Berra, will tell you the future ain't what it used to be. That means the past performance is not a guarantee of future performance. Garbage in, garbage out. Things change. Don't believe everything you read. But I kind of use this as guidance. I know these last two were hard. Any questions on this? Good. If you look at retirement funds, and almost every stockbroker, Vanguard, Fidelity, Charles Schwab, many others have retirement date funds. And if you look at those, they automatically change asset allocation over time. So if you're young, you may start off with 60% of your funds in stocks, some in international stocks to make up another 20% or so, and the rest in treasuries or bonds. As you go along in time, it starts to transition so that you have less and less in US stocks and international stocks and more in bonds, and then some in treasury protected, and finally more in cash. And eventually it will kind of level off. And the reason why it levels off is not immediately obvious, because when you're in retirement, instead of having more money in bonds than you previously had over time, a lot of it says keep steady. And the reason for that is in retirement, most people are selling their investments because they need it to live on. And usually the best thing to do is to sell the things that are returning the most. So if stocks returned a good amount of money in 1 year, that is the thing to sell. If bonds have done well in a year, but stocks hasn't, sell the bonds. But overall, you're keeping about steady between stocks and bonds. And it's keeping like that because you're selling more stock funds over time, because it's usually doing better over the long haul than bonds. Some of you have children, many of you have grandchildren, like myself. I talked about 529 funds last week. They have glide paths as well. So if you're starting out, for example, with brand new children or grandchildren and they have 18 years before college, you might want to have like 80% or more in stocks and the rest in bonds. As time goes by, you want to decrease the amount of stocks, increase the amount of bonds, and finally start having money in money market funds, so that by the time the student is in college, the money is either in bonds or most of it is in shorter term investments. And that's because by that time you don't have years and years to go, so you don't want to lose money. College savings plans, as retirement plans, also will present you with different choices. So if you looked at Vanguard or Fidelity or TIAA-CREF, which TIAA-CREF and now Fidelity managed JETI, which is the Connecticut 529 fund, it might present you with different options, like an aggressive approach, a moderate approach, or a conservative approach. And this view graph shows an aggressive and moderate. So an aggressive investment approach might start off with 100% in stocks and eventually go down to 34, 1/3 of your money in stocks, where a moderate approach might be 80% in stocks and down to 11% in stocks when the student is in school. A conservative approach probably starts off even less than 80 and winds up with no money at all in stocks. So a lot of stockbrokers or 529 plans will give you a choice. In Connecticut, as I said, TIA CREF used to manage the Connecticut plan. It's now taken over by Fidelity, but you could invest in any state's plan. The advantage of investing in the Connecticut plan, there's a tax write-off for the first $10,000 a year that you invest. So usually it pays to invest in the Connecticut plan. And 529 plans are great. I wish when my kids went to college there was 529 plans. There weren't. So I invest in that for my grandkids. Equity diversification. That's kind of the second stool to the three most important things to investing. And what that means is, I'll go through that for stocks, but it applies equally well to bonds or anything else that you might invest in. So if you invest in one stock over 1 year, it may have a standard deviation of something like 12%, which means it's almost as likely to go down as up. If you invest in 4 stocks, you could cut that in half. So it might only be plus and minus, it might be a standard deviation of 6%. If you get to 20 stocks, it might have a standard deviation of 2.7%. At 50 stocks, it's about 1.7%. So the more stocks you invest in, you're kind of buying more of the market, and there's a less and less chance that your investments will go down or up drastically. So that's why I like to buy things like index funds rather than individual stocks. If you look at the S&P 500, it's made up of about 500 stocks. Unfortunately, the 10 largest companies don't make up 10 over 500 of the stocks. It makes up about 2%. The top 2% make up about 20% of the index. So you're not getting 500, you're not getting out to 500, you're only getting out to about 20, 25. If you buy the total stock market, it's not too much better. Advice from one of my heroes, John Bogle, who started Vanguard. He's telling you, don't buy a single stock. Don't look for the needle in the haystack. Just buy the haystack. And that's what index funds do. Any questions on that? I need some questions. I'm coming towards the end. I'll just go through one more. Investing in the S&P 500 index fund. In any given year, the S&P 500 index fund beats out close to 65% of all other mutual funds. Over 10 years, it beats out 85% of all other mutual funds. Over 15 years, almost 92% of mutual funds. Over 30 years, it beats out 98% of all other mutual funds. So where are you going to get a fund that's going to beat out the S&P 500? Very, very unlikely. The only way you'll find that is you find the next Peter Lynch, who used to be the investment advisor for Magellan, one of Fidelity's biggest fund. So the question is, why doesn't everyone just invest in a low-cost index fund that follows the S&P 500? From Voltaire, better is the enemy of good enough. Just on some statistics, growing up in Brooklyn, Sandy Koufax was one of my hero baseball players. He had a 65% winning percentage over his whole baseball career. A pretty good baseball team that wins 100 games in a season is only winning 62% of the games. The best team over the last decade by percentage, the New York Yankees, only won 54% of the games. So if you could get numbers like this, why would you invest in anything else? The only thing that I might do different is the total stock market fund. So if you had a long-term horizon, it probably does better than the S&P 500. For example, the Vanguard Total Stock Market Fund has about 3,500 stocks in it. The top 500 is the S&P 500 and contains about 82% of the funds. So about 18% is invested in mid and some small companies. So like Romana said, why not invest in brand new companies? I don't like to do that, but it's good to have some money in some smaller companies as well, because there's a growth opportunity. Just a famous bet. In 2008, Warren Buffett famously bet a hedge fund manager that a portfolio of hedge fund would not beat the S&P 500 over a 10-year period. There was only one hedge fund manager who took him up on the bet. Warren Buffett won $1 million and donated to charity. He also announced if he should die, 90% of his wife's funds should be invested in the S&P 500, not in his own company, Berkshire Hathaway.
Hey, Ira, it's Kathleen. Thank you so much. I'm sorry, I have another Zoom meeting, and so I have to end this meeting. I apologize. It's gonna, I have to be at another meeting, and we're on my Zoom account. So
that's fine. I think I'm ended anyway, unless there were other questions. You could certainly hold it.
So next week, if people have questions, they'll have an opportunity to ask you. And,
thank you, Ira, very much.
Thank you, Ira. Very clear presentation.
Thank you.
It's a complicated subject.
Ira, thank you, Ira.
Very good.
Welcome.
Okay.
I have a